Investing can feel overwhelming. There are thousands of stocks out there, and everyone seems to have different advice. But here's the thing, you don't need to be a financial expert to get started. You just need a simple strategy that helps you invest smartly and confidently. In this video, I'll walk you through a step-by-step approach to picking the right stocks and using what you already know, asking the right questions, and using the best tools available. Whether you're a beginner or just looking to sharpen your investing game, this guide is right for you. Let's get into it. This is the Profit Capital, and let's get started. When you're just starting out with investing, one of the best places to begin with is with what you already know and use daily. Think about it. Netflix, you probably stream your favorite shows and movies on there all the time. If you're using it as often, so are millions of others. That tells you it has a strong user base. Apple, maybe you're watching this video on an iPhone or maybe using AirPods to listen through this. If you're a fan of the product, chances are others are too. That's a good sign of brand strength and customer loyalty. Starbucks, if you're sipping coffee while watching this, you're not alone. It's a global brand with a massive presence. And Uber, many of us rely on it to get us around for transportation. That shows you how integrated it is in our lives. So the key takeaway here is with companies whose products or services you already understand and believe in. That way, you're not blindly investing. You actually have a basic understanding of what the company is and what it does and how it interacts with the people. Once you've identified companies you're familiar with, the next step is to research them. Don't just invest because you like the brand, dig deeper. Ask yourself, what does the company actually do? Is it selling products, offering services, or maybe it's an insurance, health, techware? Well, understanding the business model helps you know how it makes money. Next, check profitability. Is the company earning money or is it running on a bunch of losses? Some fast-growing companies might not be profitable yet, but it's important to know the difference. Look at whether the company is flourishing, are its revenues growing? Is it gaining more customers, expanding globally? And finally, stay updated with news or trends. For example, if a company just partnered with another big player or released a game-changing product, that could be a great sign. On the flip side, lawsuits or scandals can take a company's stock fast. Good investing tips start with good research. Don't skip this step. Now that you know what the company does, it's time to look at how its stock behaves over time. Start by checking the 1 year and 5 year trends. Has the stock generally gone up, stayed the same, dropped? This helps you understand its long-term potential or if you want a growth rapid potential. Then look at volatility. How often and how wildly does the stock price move? A highly volatile stock can mean more risk but also more reward. If you're risk averse, you might want something a little more stable. Next, compare the stock to others in the same industry. For example, if you're looking at a tech stock, check how it's doing to other tech companies. This gives you context on whether its performance is strong or weak within its space and industry. And finally, one of the most important things to ask for yourself for long-term investors, dividends. Ask yourself, does the company offer consistent, strong dividends? That's like getting a paycheck for simply holding the stock, and it can be a great way to build passive income over time. Before you know which stocks to invest in, you need to know what kind of investor you are. If you're looking for growth, you're likely drawn to tech stocks, startups, companies focused on innovation. These these can offer high returns, but they can also come with more risk, meaning the stock price can swing a lot in either direction. Thinking about companies like Tesla, new AI startups, or biotech firms working in the next big care. But if you're probably someone who wants to safety long term, you're probably suited for the stable investments, the long term ones. These may not grow as fast, but they're known for being very reliable. We call these blue chip stocks. Companies like Microsoft, Apple, Coca-Cola that have proven track records and steady returns over decades. Knowing your risk tolerance helps you build a portfolio that matches your goals, whether that's growing your wealth fast or protecting what you already have. This is a fun way of saying of one of the most important rules in investing. Don't put all your eggs in one basket, or in this case, one hoop. You want to diversify yourself. That means not putting all your money into one stock or even one industry. Mix it up. So, example, invest in some tech, some healthcare, maybe even energy or retail. That way, if one industry struggles, your whole portfolio doesn't suffer. Another great way to diversify is through ETFs and index funds. These are like bundles of stocks that track like a group, like S&P 500, QQQ, alphabetical and many more. And they spread your risk across lots of companies automatically. And don't forget to think globally. You can invest in both domestic and international stocks to take advantage of growth happening around the world. Diversification helps protects you. It's like having backup players on your team. If one falls behind, others can keep you in the game. You're not alone when it comes to figuring out what to invest in. There are like a bunch of tools out there that can help you make smarter decisions. Start with Yahoo Finance. It's a great place to check stock prices, financial statements, and company news all in one spot. Morningstar is super useful if you want expert analysis and ratings on stocks, ETFs, and mutual funds. They'll help you understand whether something is over or undervalued. Motley Fool is gives an investment recommendation article that break down trends in a way that is very easy and simple to understand. Great for beginners and pros alike. TradingView is more advanced, but if you're looking into charts and technical analysis, this tool is a game changer. And if you're using apps like Public or Robinhood, they often have built-in analysis and community insights. Use them to see what others are watching or buying. The key is don't rely just on one source. Use a mix of these tools to get a full picture before you invest. Before you hit that buy button, run through this quick checklist to make sure the stock you're investing in actually makes sense for you. First, you understand the company. Don't invest just because like some other dude just one of your friends or like one other guy just said it's good idea. Make sure you know what the company does and how it makes money. Second, is the stock overpriced or fairly valued? Tools like Yahoo Finance or Morningstar can help you check the stock's valuation and compare it to its historical price and earnings. Third, does it fit your financial situation? Does it fit your profits, your income? Don't stretch your budget or go into debt just for a stock. Make sure you're investing money you can afford to leave untouched for a while. And finally, are you diversified? Even this stock seems like a perfect fit. It shouldn't be your only one. Make sure it complements the rest of your portfolio. Treat treat this checklist like a filter. The more boxes you can check confidently, the stronger your investment decisions will be. Thank you for watching. I hope this video gave you a clear and simple framework to start thinking about which stocks to invest in. If you have any questions or want to cover a specific topic in the next video, feel free to shoot me an email at financefrontier967@gmail.com. I'd love to hear from you. And if this helped you in any way, make sure to hit that like, subscribe button, and hit the bell icon so you don't miss future content. We're just getting started, and I can't wait to keep helping you grow your financial knowledge. See you in the next one.